Well, good morning, everyone. Today is January 7th. It's a Tuesday, and it's the first full week of the year, and it's really important. Why? Because of what I always tell you about fragmentation. Whenever the week is a little bit off, whenever there's like one day off, Monday, Friday, a midweek holiday, funds take that week off. Fund activity is very muted when markets are fragmented, and that's what I call, or trading action, or the calendar is fragmented. Sometimes you can have the calendar fragmented and you can have the sectors fragmented, which we have right now, and I'll get into that in a bit. But the big report, as I mentioned last week, the big report this week is jobless claims. Not expecting anything major. We've been really steady. Jobless claims have been at like a 50, 60-year low. Employment situation on Friday, we're expecting about 155 claims. Again, not expecting anything major. Now, the crux of the issues we're having is Iran. Is Iran going to do something to U.S.? Is it going to impact the stock market? Is there going to be a revenge? Is there going to be a war? Well, let me tell you something, and I told you guys this just a few days ago. The market is completely reacting like nothing is going on. Let me show you this. Crude oil, all right? Crude oil is down. Today's Tuesday. This thing happened over the weekend. If this was a major catalyst, you would expect crude oil to be up more than 2 trading sessions, right? These are daily charts. These are not weekly charts. It literally took us 2 trading sessions to reach overbought territory, all right? And not only that, actually, no, just Monday. Just Monday and Friday. Today, we're already down. We're already down 0.76%. So crude oil, folks, tension, Middle East, crude oil, it's not reacting. Let's look at gold. This is gold, okay? It's going to open up 0.18. We're talking about just a few ticks. We've had a rally of 2 days, and the price, boom, overbought. This is weekly data, and I want to show you the divergence that we're seeing right now. Higher highs. And, oops, excuse me. Why can't I get this done? All right. And lower momentum levels. This is weekly, so this is really sensitive to fundamentals. There's very little noise in weekly data. And as you could see, the oscillator is overbought, price went up, but momentum levels can't sustain themselves. And this is called divergence, and we were seeing this on the S&P 500 about 2 weeks ago, and since then the market has not gone higher. Divergence happens when you have a stretched out market, and then before it gets a chance to contract, it stretches out even more. And then it contracts just a little bit, and then it stretches out a little more. That's not a healthy market. For the market to continue moving, for the market to continue generating momentum, that rubber band needs to completely move back in line, and then you can stretch it out. If you stretch it back in just a little bit and then stretch it out again, it's going to eventually just get, tight. And that's what we're seeing with the gold market, and to a lesser degree to the crude oil market. We're not seeing divergence, but we're seeing overbought territory on a daily basis after just 1.5 days of rally. And that's pathetic, okay? If this is the start of a war, this is pathetic. Crude oil is basically saying, nothing's going to happen, all right? So volatility, fear in the market. Yesterday, we were flat. This is flat, nothing, no movement. You guys remember Brexit a couple of years back? Let me show you to remind you what happened. When Brexit became a hot commodity or a hot thing, look at this. Volatility went to 35. This wasn't even a war. This was just whether Brexit was going to become independent for, England becoming a separate part of the world. So this is very, very, very stable. Look at this volatility. We're barely moving. We haven't even got to fear level of 20. And the stock market, well, the stock market's kind of doing its own thing. Volatility's not even really higher than it was here, and we're still seeing divergence. So overall, my opinion, and my opinion is based on what we're seeing in the market right now, the chance of us and Iran going into war or seeing something unforeseeable or dramatic or dangerous is the same as the chance of Trump actually being impeached and getting into trouble. The market's completely just ignoring it. It's got its head in the sand. Gold is lower. Not lower. Oh, yeah, a little bit lower. Crude oil is down. It was down even yesterday before the session. Folks, yesterday was it Monday? This is like fresh data. So, in my opinion, the market is not reacting to this at all. Now, let's talk about the stock market a little bit. We need to cool off a little bit. Let me tell you or show you why again. And I'm always looking at the 10 major sectors and I'm seeing how out of line they are. And kind of the situation we're seeing with gold is similar to what we're seeing with the stock market. We're seeing grossly overbought levels where that rubber band gets stretched out. And again, before it contracts, it just gets stretched out more and more and more and more. So again, notice technology is leading, but look at consumer discretionary and look at consumer staples. Consumer staples is things people need. Consumer discretionary is things people want. They should never, ever, ever be trading next to each other. Typically, consumer discretionary is next to technology. Amazon, Apple, that's consumer discretionary, close to technology. Consumer staples is like toilet paper, okay? So very, very different. Consumer staples should be near utilities. Consumer discretionary should be near technology. If you look at it on a 1 month basis, this is just 1 month, notice technology and consumer discretionary are next to each other, and utilities are down here, consumer staples are down here. Over a month period, we're not seeing over a 1 month period, over the last 25, 30 days, we're not seeing that fragmented. But when we average everything over the last 6 months, 3 months, and 1 month, they're not cooperating. So what you're seeing here under 1 month, this is how the sectors should look. Technology, consumer discretionary, a little stuff in the middle, and then utilities and consumer staples and real estate and materials near the bottom. Speculative near the top, health, discretionary, technology, and defensive near the bottom. But when you look at the average, you're not seeing that. And that's telling me stocks remain fragmented until they cool off and come down a bit. And again, I'm not expecting anything crazy. I'm just expecting stocks to come down to the 50-day line right over here. Nothing major. No children or animals will get hurt in this experiment. I'm just messing around. But seriously, just a little pullback, just a 10-point move in the SPY. That's all we need. It'll put the RSI back to neutral or lower. It will cool off our sectors and bring technology back down to consumer discretionary, because technology is outpacing consumer discretionary because semiconductor stocks are leading ahead due to the potential, trade war being worked out with China. So again, they shouldn't be this far apart. And this sector, this is the 10 sectors of the S&P, and it's telling me they're fragmented. Until they get fragmented, markets are going to be in a holding pattern. And when markets are in a holding pattern, you know what that means? It's the best time for income strategies. When markets are not fragmented and when they're consolidated and when they're not overbought and when they're not diverging, that's when you want to trade. But when markets are fragmented, when that rubber band is stretched out, when you're seeing divergence, when things are all over the place, and that's kind of where they're at right now, income strategies are best. Now, did you guys happen to watch Rob Booker yesterday? It was an amazing event. It was informative. It was shocking. And for the 3 attendees there, it was extremely lucrative, right? Now, I want to look at these numbers. These numbers are amazing. He showed you how to collect instant income of $1,470, $1,760, even $1,748. That's not chump change. That's real money. And you can watch you can learn exactly how he did it by following the link below. You don't want to miss this out, especially when markets are fragmented, when markets are choppy and doing this, when that rubber band is stretched out. You want income strategies, all right? Now, these were regular people. These were not professional traders. These were not guys who knew how to make money. Rob picked regular people, people with no special or any kind of financial experience or training. His strategy is really easy. And the best part, you can get all the details right here. Follow the link. Watch this video now. Again, I'm going to review for you guys so you understand. It was extremely informative. It was shocking, and it was lucrative for the 3 people that were there. We saw gains of $1,470, $1,760, even $1,748. So it's not something that happens once in a lifetime. Rob showed 3 regular people right away how to do it. Watch exactly how he did it. Learn from the best. Regular people, no special training. And the best part, folks, the market is prime for that right now. It's prime. You don't want to miss this out. Follow the link below. Learn all the details. Get in on it now. Talk to you soon. Take care.